Christmas, everybody. Thanks for joining us, and welcome to another edition of the Wealth Guardians radio show, where our motto is we tell you what you need to hear and not necessarily what you may want to hear. JB is joining me today in the studio. Hey, JB, Merry Christmas. It's here, man.
Merry Christmas. I know. Here we are on what? Christmas Eve, and
Eve, yeah.
I'm ready for my long winter's nap.
Oh, you got that right. I tell you what, it's a fun time of the year.
It sure is.
I love it so much, and this is the wrap up of the year. This show, so we'll this is our year end show, and we'll get to some listener questions here in a minute. But for those of you who don't know me, and maybe just tuning in for the first time, I'm Doug Ray. I'm the founding principal of Ray Financial Group. And we're a professional independent firm working with pre-retirees and retirees in all areas of retirement, estate planning, including the areas of wealth management and preservation, asset protection, tax reduction, wealth transfer, and distribution. Well, that's a mouthful, isn't it?
It is.
We're fiduciaries with a fiduciary duty, and I have always run my practice that way. We have offices in the Charlotte and in the Triad in the Clemens area, and we can be reached at 336-391-3409, or please hop on our website at www.thewealthguardians.com. We got a lot of great information there that you can download and read. So the objective of this show is to educate and inform all of our listeners of up-to-date, relevant, and important information in the pre-retirement, the retirement, and estate planning arena. So, again, welcome to the show this morning. JB and I look forward to spending the next 30 minutes with you and giving you some solid information that hopefully will help you make a difference in your retirement planning.
Sounds great. Well, hello, everyone. Welcome again to the show. I am JB, and you have asked the questions, and now it is time for some answers. As always, once a month, we get to answer some great questions from some of Doug's listeners on the radio show. This month, as you can imagine, the majority of the questions are concerning the tax reform plan that was signed this week by President Trump. We will get into the details of this plan and answer all of your questions pertaining to it when we come back. So please stay tuned. We'll be right back on the Wealth Guardian Show here on 94.5 WPTI.
You might have thought there were only two places to put your hard-earned retirement money, a savings account or into the stock market. Most savings accounts pay interest that is, laughable. And with your money in the market, there's always the risk of loss, and that includes your 401k. Remember 2008? Do you want to go through that headache again? Can you afford to go through that headache again? Would you like to know what other options might be right for you? I'm Doug Ray, and I'd love to have that conversation around your goals, strategies that capture market growth without risk to principal and still allow access and control of your money. Want to know more? There's no cost or obligation to meet with me. Call us at 336-391-3409, 336-391-3409, or contact us online at thewealthguardians.com.
Welcome back to the Wealth Guardians radio show here on 94.5 WPTI. As we said before, it is time for our monthly question and answer show. And for this month, we were hammered with questions relating to the recent tax reform plan put out by the Trump administration this past week. And since it is so important and will affect everyone's lives and retirement plan in some way, we felt that it was very important to explain the different aspects of the tax reform plan and to answer many of the questions about the plan. So, Doug, let's go ahead and get started.
Yeah, JB, like you said, we've got a lot to cover today, and we did get a swarm of questions after the release of the proposed tax reform plan by the Trump administration. Everyone's curious on what the tax proposal means and wants to know how it will affect them. Of course, everyone has hope that it will save them some money. I do. But there's different elements to this plan, and there's different circumstances to go over. Of course, that proposed plan has some very attractive features and some parts that will negatively affect many Americans. After many people saw the many different elements of the proposed plan, the questions started coming. All of these questions received are related and come down to one essential thing that people want to know, which is, again, how will these tax law changes affect me personally? So we're going to answer many questions relating to the different aspects of that plan, and in an effort to help you figure out how this proposal may affect you personally.
Well, Doug, here are some of the more popular questions that we have received. Who benefits the most from this proposed plan? What deductions will be eliminated? What deductions or credits will be increased? How could my tax bracket change? Now, these are some very good questions, but the most popular question we have received so far is, if this proposed plan becomes law, how will it affect me personally, and should I be doing something to help take advantage or protect myself from these changes?
Yeah, JB, let's start with some specific questions and work our way through the most important ones that's going to affect you personally. The first question is, how would my tax bracket change? So, one of the biggest parts of the tax proposal is simplifying the tax code itself. The plan calls for reducing the number of tax brackets from our current 7 brackets to a 4-bracket system. The tax brackets would go to 12%, 25%, 35%, and 39.6%. So the current 10 and 15% brackets kind of get squished into the 12% bracket. The current 25 and 28% brackets would become just a 25% bracket. And the current 33 and 35% brackets would just become 35%. And finally, the current top tax bracket of 39.6 is going to stay. So it seems. So for 4 tax brackets, the key here is income ranges between each of these brackets are really what determines where and how your income is taxed. For example, the current married filing joint 15% tax bracket is for incomes between $18,650 and $76,000. The proposed 12% bracket would cover incomes all the way to $90,000. So this part could save Americans a lot of tax dollars. We'll get into more detail on the actual numbers here in just a minute.
Okay, Doug. Well, another popular question that we have received is, what deductions have been changed or eliminated?
Well, JB, there's several here. The biggest one has to do with the standard deduction. Currently, for single filers, the standard deduction is $6,350. This would almost double to $12,000, and the standard deduction for a married couple filing jointly is $12,700, and this is almost going to double to $24,000. However, to help compensate for the increase in the standard deduction, the proposed plan would take away the personal exemption. So the increase in the standard deduction and the elimination of the personal exemption will help some people save some money while costing others. It's almost basically a wash.
Right.
So the proposal also increases the child tax credit from to $1,600 from $1,000, which it currently is, and it also provides a $300 credit for non-child dependents such as a spouse.
Well, Doug, what other deductions would be eliminated in the plan?
Well, one deduction that's going to be changed, and that's getting a lot of press right now, is the mortgage interest deduction. The mortgage interest deduction will be cut in half, affecting home buyers in expensive housing markets. Another popular deduction for those that itemize is the deduction for the state and local taxes, which they call that SALT. Mm-hmm. And that's going to be eliminated. So deductions for state and property taxes would be capped at $10,000. Medical expense deductions would be eliminated. So these changes could greatly reduce the amount of people who itemize instead of taking that standard deduction. Even though the standard deduction is going to go up substantially for many Americans, it's not going to go up enough to make up for these deductions that could be eliminated, and especially with the elimination of that personal exemption.
All right, Doug, well, here's another question. There's lots of press about the possibility of reducing the amount that people could contribute to their retirement savings plans like 401ks and 403bs. Any changes here?
Well, fortunately, no. I mean, that would have been terrible. I mean, we're not saving enough money in America as it is, and if you eliminated that deduction, I'm afraid to say what would happen to it.
Right.
There was a lot of backlash on that item, and President Trump made sure not to change it. Taxpayers are still going to be able to deduct their 401k saving contributions and be able to contribute the same amount before taxes to these plans. However, there are some proposed changes to retirement savings plan that you need to know about. One is regarding contributions after taking a hardship withdrawal. Currently, someone taking a hardship withdrawal from a 401k can contribute again cannot contribute again until a 6-month period has passed. The bill would eliminate that restriction. This is a good fix, as many times people take a hardship withdrawal for immediate needs such as a medical bill or a new roof or something like that. So why penalize somebody 6 months, to pay off a medical bill?
Right.
It doesn't make sense. Another fix here regarding hardship withdrawals is before you could only access the amount you contributed, but now the new law would also include matching contributions as well, as long as you're vested. And finally, there's a proposed change to the way you repay loans. Currently, if you have an outstanding loan from your 401k and you lose your job, you generally have to roll that money into an IRA or a new employer plan within 60 days. And if you don't, the loan becomes taxable and subject to a 10% interest penalty if you're under 59.5. The proposed tax law says a worker who was terminated with a loan outstanding would have until their taxes are due, so it'd be April 15th of the following year, to repay it into an IRA or plan at a new job. This gives people more time to take care of things, which is, I think, good.
Right.
So, as you can see, so far, this tax reform bill has a lot of different items and reaches a lot of different areas, and it's not just about making tax code simpler or reducing the tax rates. With all these different changes, it really depends on your situation as to will actually save on taxes or not. So that's what we're going to begin to the next part of the show. We're going to take a look at some different case examples and give you some ideas that affect the different situations that you might come across. Hopefully, you'll get an idea of how this tax proposal would go into effect. All right, so I know we're right here at Christmas time, and I know most of you folks are not even thinking about planning, retirement, your money. I mean, it's all Santa Claus right now. I get that. But let's do this. I want you folks after the new year to give us a call at 336-391-3409. Let's meet in my office in Clemens and sit down and have a conversation about your planning, your retirement, these tax code changes, and how that may affect you going forward. It's free. It's no obligation on your part. I'm offering my time to help you out. The number's 336-391-3409.
Sounds good, Doug. A quick reminder, you are listening to the Wealth Guardians radio show, heard right here on 94.5 WPTI. We certainly appreciate you being with us today. Remember, we can be reached at 336-391-3409 or visit the website at thewealthguardians.com. Stay with us. We'll be right back here on the Wealth Guardian Show.
I'm Doug Ray, and while I'm a financial planner, more importantly, I'm a financial educator. I've made it my mission to clearly explain the reasons behind strategies we use to create a personal pension and lifetime income. Are you worried about having enough money in retirement or outliving what you put aside? Almost all the experts say a market correction is in our future. I have solutions that have helped hundreds of your neighbors sleep easy at night. Solutions that capture market growth and protect your principal from loss, all while considering maximum tax efficiency. As a chartered financial consultant and retirement income professional, I want to start a conversation to see how we might serve your retirement income needs. Want to know more? There's no cost, no obligation to meet with me. Call us at 336-391-3409. That's 336-391-3409.
Welcome back to the Wealth Guardians radio show, where we tell you what you need to hear and not what you want to hear. I'm JB, and we're right in the middle of our question and answer show regarding the Trump administration's recently released tax reform plan. As Doug said before the break, let's take a look at some of the factors of the tax reform plan that could cause you to either see a reduction in your taxes or an increase. And we'll also try to give you some case examples.
Yeah, JB, President Trump's plan is being billed by the White House and Republicans as a great tax savings plan for the middle class. But, is it really?
Right.
How much exactly would depend on some different factors here. Again, the main part of the GOP tax plan is to simplify the code. In the current proposal, the number of brackets, as we said in the first segment, goes from 7 down to 4. So, currently, the 10% bracket goes from 0 to $18,650. The 15% bracket goes from $18,651 to $75,900. Now, in the new plan, the new 12% bracket goes from 0 to 90,000. Mm-hmm. And then the 25% bracket kicks in at 90,000 to 260,000. Now, this is where I kind of get excited. And let me explain why.
Okay.
You know, I'm a big, big believer in Roth IRAs.
I agree.
And we've talked about that
We have.
a ton on this show. So what this new plan does is it gives everybody out there, all you listeners, more capacity to get your forever taxed money to never taxed money. Mm-hmm. Okay? I'm talking about a Roth conversion strategy. We got bigger, fatter brackets now to work with at 12% and then at 25%. So that's what really excites me about this new plan. I think going forward, that's going to help a ton of folks in the future. So, you know, we go all the way up to that 39.6% bracket in the new plan, which is incomes of 1.2 million and up, which is huge. But, you know, the first big factor here is the majority of Americans, they don't itemize their taxes.
Right.
Okay. And according to the most recent IRS analysis of individual tax returns, 70.4% of taxpayers claim the standard deduction on their tax return. And for those Americans who do claim the standard deduction, most will be able to reduce their taxable income further under Trump's new tax plan, in turn reducing their tax bill. Single filers, you know, they're going to deduct $12,000 and slightly higher in the current standard deduction on a personal exemption of amount of $10,400. A joint filer, they're going to deduct $24,000, and that's up from $20,800. So let's put a case example out here and go over this so people can understand it.
Sounds good.
So a single filer with a salary of $25,000 would give that person an estimated annual tax savings of $178. If that person had a $75,000 salary, they'd save approximately $2,000 in federal taxes. And if that person had a $175,000 salary, they'd save approximately $4,200 in federal taxes. Again, it's being based on deductions that are higher than the standard deduction and adjustments to the tax brackets and income limits within those tax brackets.
Well, Doug, let me jump in here. So what would happen for a married couple in this case?
Well, you know, JB, similar. A married couple earning $50,000 in salary, they're going to see an approximate federal savings of $177 on their taxes. And for a married couple earning $150,000, the federal tax savings would be about $3,700. And if they make $350,000 in salary, they'd see about a $7,000 tax savings. Again, it's all based on the standard deduction and adjustment to these tax brackets. So, for those who itemize, this situation may change, either reducing the amount of tax savings or possibly causing a tax increase. And that's because if you're itemizing more than the standard deduction, then obviously you will see less deductions. So for some people, they're going to get less tax savings or a tax increase under that scenario. And it comes down to the new tax brackets and taking the standard deduction or itemizing around these limitations.
Well, another major talking point of this tax reform plan by the Trump administration was to simplify the tax code so you can do your taxes on a postcard, basically. Is figuring your tax rate this simple now, Doug?
Well, not exactly.
It's dealing with the government. It's nothing going to be that.
Anything that comes out of that D.C. Beltway is not that simple. And it should be. It really should be.
Well, pipe dreams, you know.
Yeah. This is because we don't have a flat tax system. We have a progressive-based tax system, meaning that different income amounts are taxed at different rates. If your income falls into the 25% bracket, you don't give the federal government 25% of all of your income. The progressive system works differently. Here's how it works. This is the most basic kind of calculation for a single taxpayer. First, you figure out your taxable income, your annual salary, the deductions, exemptions. then everyone pays 10% of federal income tax on the first $9,325. Then everyone pays 15% on the next $9,326 to $37,950. Then everyone pays 25% on the next $37,951 to $91,900. And so on. You go through the rest of the brackets as you can see. So the progressive tax system, we're keeping that whole idea intact. I don't believe it'll be as easy as to do your taxes like they were hoping. You're just not going to be able to do it on a postcard. And especially if you own a business, you're not going to be able to do your own, most likely not going to be able to do it on any kind of a postcard. Likely as not, we're not going to go to a flat tax system. I wish we would, but we're just not going to do it, apparently. So your tax bracket only applies to the amount you earn above the minimum income threshold for that bracket. For income below that limit, you pay the same federal income tax percentage as everyone else does. And even if you earn less than you do overall. I know this is confusing, especially on radio, but the bottom line is the new tax proposal, tax cut plan is going to save some people some money and it will cost some people some money. All right, so now that we have a new tax code in place, what most people are going to do is sit down with a tax professional and a retirement professional who does some tax planning and go through your individual situation and see how it's going to affect you personally. See if there are any moves you can make to take advantage of the current system or protect yourself from higher taxes. Now, because this proposal will get approved under the Budget Reconciliation Act, it's going to expire in 10 years. That means this proposed tax system would expire 10 years and then taxes would revert back to what they used to be. So, we look at this as a tremendous planning opportunity. Let's seriously take a look at doing the Roth conversions now. Let's take advantage of this thing while we got it. You know, maybe when we go through the process over the next few years, they'll make it more permanent. They'll make some adjustments. They'll tweak it. But right now, it's going to revert in 10 years. So let's take advantage of the situation we have at hand. You know, JB, I was just sitting here thinking as we went through that whole process, taxes is really a terrible subject right before Christmas.
It is.
I mean, honestly, but people need to know this stuff, you know?
Well, they wrapped it up and put it under the tree for us this year.
Yeah, you know, and Trump, I mean, you give him his due. He did say that this was going to be a big Christmas present for everybody. And I'll tell you the truth. I'm optimistic about it. For a lot of reasons. Yes, it's going to save most people some money. Where it's really going to impact the American economy is in the corporate area.
Right.
Those brackets really get cut.
Right.
And there's $4 trillion sitting overseas that can be repatriated at 21% versus 35%. Mm-hmm. That's huge. And, you know, I think what that's going to do is it's going to give us a pretty good market into 2018. Mm-hmm. I know we're expensive right now. We have been expensive for a long time. And I've been, you know, for years, I've been kind of the proverbial bear on the market because of the debt, because of how expensive it is. But I am very cautiously optimistic on next year. And I'm positioning all my clients to to take advantage of it.
Right.
I personally witnessed what happened in the 80s with the Reagan tax cut. I mean, that's when, you know, my wife and I were getting our newlywed life together. I was a naval officer then, and the economy just sprang forth. Mm-hmm. And tax cuts work. Right. They just do. Right. And, you know, I know a lot of politicians out there like to say negative things about tax cuts. You've got two different philosophies in D.C. One side of the aisle basically says, you know, let government do it all, give the government all your money. The other side said, no, you know, we're free. We can make better decisions with our own money than government can. Right. I tend to be in that camp. Right. And We haven't had tax reform in 30-some years.
Right.
It's high time for it.
It is time.
I think they could have done more. I think maybe in a year or two, as we see the progress of this one, maybe they'll do more.
Right.
I hope so. But anyway, here we are with a brand bright new year ahead of us and Christmas right around the corner and a tax cut.
A tax cut.
How about that?
Wrapped up under the tree.
Yeah. All right, JB, this is it, man. This is the final show of the year. I want to wish everybody a very, very Merry Christmas and a Happy New Year. And we'll be back at this in January.
That's right. And, of course, we want you to enjoy your family, enjoy your friends and family. Remember what the season is all about. And then after the holiday, we got some, no doubt we're going to be talking more about this tax cut. And, of course, people are going to be having some questions. And, Doug, obviously, if they want to contact you, tell them again how they can do that.
Yeah, it's pretty simple. Pick up the phone, 336-391-3409, 336-391-3409. You can go to our website at www.thewealthguardians.com. Or, hey, I got an email. It's doug@thewealthguardians.com. Shoot me a line. I'd like to chat with you. I'll be checking emails during the Christmas holiday, so shoot me a line, a question, or whatever, and I'll respond.
Sounds great. Well, Merry Christmas to you and your family, and everybody. We'll talk to you again soon.
Merry Christmas, everybody.